Jake Hanley, Managing Director and Senior Portfolio Specialist at Teucrium ETFs. What is the outlook for commodities in 2026?
Yeah, so as we enter 2026, I think we're seeing a clash between a near-term cyclical um, headwinds and really long-term tailwinds, especially as we're looking toward the build-out of data centers, AI. I mean, Elon Musk wants to have a colony on Mars, so that's going to take a lot of commodities. Okay, so I think longer term, the commodities on the whole will be experiencing, some significant demand, but in the near term, we're looking at some cyclical slowdowns. Um, Oil, for example. I mean, you look at the chart of oil, there's an oil glut out there that is certainly weighing on broad commodity indices, such as the BCOM, for example. Um, but when you look at something like copper demand is accelerating, and there are structural supply issues in the copper markets that should put a tailwind under copper for sure. And so you kind of have again this clash between two different narratives, long term, intermediate term. And then in the grain commodities where we are really focused, we see a situation where grain prices have come down substantially since 2022. Um, but we do see global supplies tightening, particularly in markets like corn. We see supply disruptions with soybeans during the trade war. And so there are pockets of opportunity emerging amid this clash between the short term and long term, story that we're talking about here. Now, all that said, I do think advisors and investors stand to be selective with these markets.
All right, say more about that. How might commodities play a role in portfolios for financial advisors and their clients?
Yeah, so advisors have looked to commodities for a long time to be portfolio stabilizers. Commodities in general traditionally have low correlation to traditional assets such as stocks and bonds, and stand to provide potential portfolio diversification benefits if stocks fall out of bed, right? So, investors will know they want to have something that zigs when other asset classes zag. And so positioning commodities in a portfolio that is strategically allocated to build resiliency makes a lot of sense. For agriculture in particular, again, that's where we spend a lot of our time. We think it's particularly interesting because agriculture generally doesn't get the same amount of attention as something like gold or even oil. And so right now, talk about clashing markets. Oil prices have, headed lower this year, whereas gold prices are screaming. Futures, for example, the front month WTI crude oil is down 21% year to date. Gold futures are up 64% year to date. And if you have exposure to a broad commodity index like the BCOM, for example, on one hand, you're getting pulled down by oil. On the other hand, you're getting lifted up by gold. We haven't mentioned agriculture, right? And so agriculture fitting into this right now is weighing on your portfolio because returns have been kind of choppy recently in a structural downtrend. But we know from history that agriculture is not cyclically tied to the economy like oil is. And while gold is really rallying right now because of geopolitical concerns, those same types of concerns can work to put support to grain prices as well. Okay. And we see, Russia-Ukraine story, those tensions, hopefully we have a peace deal soon, but those tensions continue to play out. We see trade war with China, as we've mentioned before. And so those are presenting opportunities for grains. Now, it's important to know that if you're looking at commodities broadly, adding the grains to that commodity sleeve can and has historically helped that diversification component. For example, we know that in the last seven stock market corrections of 10% or more, the corn fund index, the wheat fund index, and the soybean fund index have all outperformed the stock market. In fact, on average, the S&P drawdown in the last 7 years, and we say 7 years or seven times, excuse me. This is going back to 2012, where we started our Teucrium Agricultural Index. Going back to 2012, the average S&P total return index drawdown of 10% or more, it's a mouthful, 18%. Okay, so if stocks go down on average 18%, corn has a positive performance during those drawdowns. So you have that potential diversification benefit built into these commodities that have low historical correlations to traditional asset classes. And we think advisors are going to be looking more at this space, especially as we look to 2026 with some of the concerns we mentioned with geopolitics and tightening supplies globally.
And finally, can you just tell us the types of ETFs that Teucrium has?
Oh, so we just updated our website. We have everything from crops to crypto, as it says on our homepage. And so, corn, wheat, soybeans, sugar, those are our traditional markets that we follow. We are in the crypto business now. We have a levered XRP ETF. And we are also in the business of white labeling other issuers' products. So, if you know anyone who has a good ETF idea and wants help bringing it to market, we're in that business too.
Jake, thank you very much for your time.